we've seen this irony of news that's related to inflation, high inflation being bad for gold because the traders think the Fed's going to raise rates and that's bad for gold. What we've seen more recently, though, is another kind of buying step in when that happens, where it looks like people are saying, you know what, high inflation, I want some gold. So we might see very different dynamics going forward this year. The real rate thing, I think, will only be part of the story. There's evidence now that there's another kind of buying out there.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Lobo Tiggre from the Independent Speculator. Lobo, thank you so much for joining us today.
Thank you, Elijah. Always happy to talk about liberty and finance.
Definitely. Talking about both today. One of the things, I guess this is good for liberty, is the opening up of a lot of the economies in the world. A lot of countries are removing all COVID restrictions. Here in the U.S. as well, a lot of states are open up as well. So your perspective on how this great reopening, as you call it, is going to impact the economy in the U.S. and worldwide.
Sure. Well, I'm not the only one talking about this, of course. It's so big and obvious a megatrend that it's subject to a lot of ink on a lot of different publications. But I do think that there's a tendency to underestimate this. And if you think about it, what precedent do we have for something like this? You have to go back 100 years to the previous big pandemic like this, and the world was completely different back then. So I don't have a hard economic trend with data to back up any kind of projection here, Elijah. But if I just think about human psychology, and I think about people that I know, I think about, my own self, my family. Like when London started opening up and Boris Johnson talked about reducing the restrictions in UK, I told it to my wife, and she looks at me and says, when are we going? Right? That's just the instant response. And I think that's very human. And I think that will be multiplied across really the large chunks of the entire population of the world. This is a big, big deal. And I mean, just look at the trucker convoy in Canada that's become the horn blast heard around the world. There are now trucker protests in the U.S., in France, and even in Brussels. It's really quite phenomenal. So I can't give you a number here, like this is how much higher this is going to drive oil prices or how many points of GDP this is going to be. I just think that all investors should be aware of this as a big factor that I think could be a confounding variable. Like, for example, let's just take inflation. Everybody's talking about how base effects are going to make it harder for inflation to go higher in the near term. And I can see that. The big increases last year started really in April and then going forward. And we're getting close to that now, to where, that's going to have a negative impact on higher inflation numbers, if that's what you're looking for. But at the same time, you've got this great reopening. And if just about everybody who's put off a vacation is now going to want to take it, or put off business trips, they're now going to want to do that business. In my business, the kind of due diligence required to make great stock picks, I put a lot of that off. I've had to go with what I can see on the internet, and that's just not how I do things. I want to get my boots on the ground and proof a story before I invest in it. And the big mining companies, they need to do their due diligence before buying the little ones. M&A has been repressed for the last 2 years, which I see as a giant spring in that part of the business. And again, just think personally, how many people haven't gone to go see grandma for 2 years because they didn't want to kill her by bringing a germ with them? I think those people are going to get in the car and go see grandma. So trains, planes, automobiles, it's all going to be, I think, a very big surge that has implications for energy prices, despite the the new production supposedly ramping up. OPEC is failing to, I'm throwing a lot in here, but it's a big question, Elijah. OPEC is failing to meet its increased quotas, but it is increasing output. The U.S. is also supposedly ramping up its production again. So there's people making a near-term bear case for oil, but it could easily be completely swamped out by the great reopening. So once again, I'm sorry I don't have a hard number to give you. Like this is how much the great reopening is worth in increased oil prices. I don't have that. I don't think anybody could give you that, not realistically. But I think it is a serious factor that everybody should consider. And on the liberty side, I just got to say personally, I get some grief for this because people think I'm anti-medicine or anti-science or something. I don't mean that at all. But I'm actually very pleased to see just average people standing up and saying no to Big Brother in ways that we haven't seen for a long time, really since 9/11. Anybody in uniform became a hero, no matter what they said. And for people have a right to stand up and protest. I don't know that they have rights to close down bridges and stop commerce, but people have a right to stand up and say, hey, this is what I believe in, and I want my freedom. People have every right to demand that. And I'm glad to see people doing that. I had feared that people had kind of had that whipped out of them. And so I'm kind of glad to see some let me not mince words. I am glad to see North Americans and people around the world showing some spine and telling Big Brother they've had enough.
Now, do you believe this reopening of the economy will be bullish for the stock market or just like commodity prices?
Well, on its own, I think the great reopening is bullish for just about everything. Now, if it causes inflation to surge despite the base effects coming into play, and the Fed panics and does one of these shock and awe moves people are talking about, so I think it's kind of silly to think of 50 basis points as shock and awe compared to 7.5% inflation or 9.7% producer price index that we just got out this morning. 50 basis points is peanuts, so I don't see that as shock and awe at all. But if the numbers keep coming in hot, the great reopening prevents the numbers from rolling over in the near term. I mean, there's a lot of people who are already saying we're at peak inflation. Actually, it's a rolling target, one of these moving goalpost things, Elijah, where there were people in December, mainstream economists, talking about peak inflation already. And now it's January's peak inflation. But we'll see. I don't see it cooling now. I think they're going to say, oh, no, February was peak inflation. We'll see how that goes. But what I'm saying is if that keeps moving, right, if it's not February, then it's March, not March, then it's April, and if the great reopening pushes that all the way through the summer, it's just, the Fed will have to do something. I'm one of those people who really resist saying that the Fed has to do something because it seems to be very good at making excuses for not doing what anybody expects. But I just don't see how they can let inflation run that hot that long. Even if what they do is ineffective, they have to appear to try to do something, or the voters will be really upset. The powers that be need to at least appear to appease voters. And I just don't see how, if the great reopening keeps inflation running hot for months beyond what people are saying now, I don't see how they can fail to react. And that reaction could quash the stock market. I mean, if they really do some real shock and awe, start raising by percentage points, or really more aggressively drawing down the balance sheet of the Fed, I think markets could tank. So you could see actual economic heat, not just high prices, but people out there spending, building, making new business decisions like I was talking about before. You could see real economic heat, and you could see the powers that be slam on the brakes, and you could see the markets reacting very negatively. So that's kind of a yes and no answer, Elijah. I don't know if it satisfies or not, but it depends on how it plays out. But on itself, just the great reopening, never mind what the Fed does, just the great reopening, I think it's flames under the fire on just about every pot on the stove right now.
No, the interesting thing about if the Fed does raise rates, if you look back at in the 80s inflation where Volcker raised rates very, very aggressively, he had to do it very aggressively. And even then, inflation didn't cool down for quite a while. So it seems like your projection of inflation for quite some time will turn out to be correct. Yes, I mean, not to give the other side credit here, but so they had real persistent inflation to deal with then,
And Volcker didn't just have to get aggressive. It wasn't just shock and awe. He had to raise interest rates above inflation in order to really, put the pain on the economy, to stop spending. He had to force a recession. And the powers that be now, they're trying to find the so-called mythical soft landing. They don't want a recession. They want to try to somehow cool things off without causing any pain. That's just it's a fool's errand. That'll never happen. I don't believe that for a minute. But there is actually the thing that we were talking about earlier, the base effects on the inflation numbers. That's a real thing. When you had inflation in 2021 posting large monthly gains month after month, and now we're coming into the period where that's the comparison, like we're comparing to those same months last year, that does make it harder to increase by the same amounts this year. So even though I don't buy the transitory story, it is possible that we'll see lower month on month. Like I'm not seeing deflation, mind you. I'm not seeing inflation go lower, but we could see the monthly increases drop significantly if, say, I'm wrong about the magnitude of the great reopening. If nothing else happened, if everything else remained the same, it would be hard for the monthly increases to keep up with last year, and that could give the Fed some wiggle room. That could mean that we don't need to have shock and awe. I don't believe it for a minute, but it could allow people to imagine that there is this path to this soft landing where the Fed doesn't have to do so much. And if you look at what the Fed has actually said, you look at Powell's remarks, and more recently, Daily Bullard's coming out more aggressive, but it seems like they always have this good cop, bad cop thing going on. Right now, it's Bullard and Daly. And Daly's aligned with Powell, and they've so-called retired the word transitory, but they still believe it. They still think that due to base effects and due to the supply chains getting fixed and so on, that inflation is going to come down on its own. So they don't think the Fed has to raise interest rates higher than inflation. They're not talking about raising interest rates above 7.5% to try to tame inflation. They're talking, maybe 2.5 is the terminal rate of the raise, because they really think that inflation is going to come down that low over the next year or two. Or they're saying they think that. So, if they really believe that, if they believe what they're saying, and Lagarde is saying similar things across the pond, it's not just the Fed. Many central bankers seem to be acting on the belief that, the COVID thing was in fact transitory. It's taken longer than they expected to blow over, but it is blowing over. And so it would be a mistake to panic, to raise rates too much when rates are going to come down anyway. This is a huge variable right now, Elijah. I can't tell you how it's going to go, and I wouldn't believe any of your guests that came on and said, I know this is what's going to happen, and this is what the Fed will do. I think we have very crucial data points coming up in the weeks immediately ahead. What happens in the March meeting? There'll be another CPI print and another labor report before then. These are big variables, and depending on how the things you and I are talking about right now go and what we see in those numbers, can make a big difference in what the Fed does, and therefore the outcome for all sorts of markets, commodities, everything.
And we did recently get the CPI numbers out a couple weeks ago at 7.5%. The producer price inflation just came out recently, 9.7%, so nearly 10% right there. And yeah, it just continues to go up. So it doesn't seem like there's any reason for it to slow down anytime soon.
Well, I understand that lumber has come off a bit. I understand that the automakers are resolving some of their supply chain issues and stepping up to the plate, and there's an expectation for car prices to come down. So I don't want to just say, I'm right, everybody else is wrong. There's no sign of deflation, or sorry, not deflation. There's no sign of cooling inflation whatsoever. There are some signs of possible impact that could reduce inflation. But if you look at the numbers, they're still going up. Like it's almost 2 months ago now, I posted a cartoon that a Reuters poll had shown of we're talking audio only, so I can't show the audience this chart, but it's like a mountain peak, right? If peak inflation in December looks like a mountain peak, it was going to go down afterwards. And now that mountain peak, well, it turns out to be a shoulder of a higher peak. And now it's peak inflation. This is what I was mentioning before. These guys keep having to redraw their cartoons, because every time we get a fresh print, as the ones you were just saying point out, this peak keeps moving higher. So until that actually does roll off, I think it's very dangerous for anybody to make a new assumption. Oh no, this month it really is peak inflation. Let's see that peak before we start jumping to that conclusion, because it really is a jump right now. There's no way anybody can point to the charts and say, yeah, it's peaked. That's not there yet.
And what we've discussed before is that the key for gold is real interest rates. So as long as inflation stays above the interest rates, then this should be bullish for gold and possibly even silver.
Yes, for both. And yes, negative real rates. I mean, those are going to be with us for a long time. If I'm right about what I'm saying, that the Fed is going to remain behind the curve because it doesn't want to get too aggressive. It thinks that inflation is going to come down on its own. So it would be a mistake to raise rates too high. Then rates are going to remain below inflation, for the duration of that belief. And that means negative real rates, which is supportive for monetary metals, gold and silver. That said, the directional change does matter. I don't want to be a cheerleader here who says, no, gold can only go up and up and up. I get hate mail when I fail to be the cheerleader for gold bugs. But the reality is that the directional change matters. If rates become less negative, right? If the Fed is seen, or if interest rates are seen to catch up a bit with inflation, then that can be seen as bad for gold. And the traders, maybe not you and I, or people that go down to the local coin shop to buy gold and silver rounds, but the traders, the futures traders, whose sales we mistakenly refer to as the prices of gold and silver, they'll look at that. And if they say, oh, real rates are getting less negative, then, they might sell some goods. Funny, I got an email not too long ago from somebody who says, oh, the Fed's going to raise rates in March. That's 100% certain. The Fed's going to raise rates in March, so real rates are going to get less negative. So that's bad for gold. I said, well, how do you know that? In the first place, it looks baked in the cake, but who knows? The numbers may change the Fed's mind. But even if they do, if they raise rates, say 50 basis points, so-called shock and awe, 50 basis points. But let's say inflation comes out at 8% next month instead of 7.5%. Well, they didn't make real rates any less negative at all. They just kept up with how negative they are. So I think it's pretty dangerous for investors to jump the gun on this. We need to look at what that does happen. So what does this boil down to? What I'm saying is, if rates start rising and inflation cools, like if we start seeing monthly increases in or meeting increases in rates, and we start seeing the monthly increases in inflation cool off, that could represent a directional change that would be a headwind for gold and silver. And that doesn't mean they're going to tank. That doesn't mean they're going back down to multi-year lows or something like that. The rates would still be negative. They would still be very supportive. But it's hard to see gold and silver breaking out higher if it looks like real rates are getting less negative. Now, this may sound pretty convoluted. I hope that makes sense. But you know what? That depends on the futures traders and their pricing of these contracts that they swap back and forth. If the average person out there doesn't pay any attention to that at all, but just says, high inflation, I better have something as a hedge, and they start buying more gold and silver, you know what? This can change that whole market dynamic. And as our mutual friend Rick Rule likes to say, the multi-decade average allocation, safe haven allocation for global assets worldwide is around 2%. But recently that's dropped to 5%. So if, never mind everybody becoming gold bugs, that's not likely absent a Mad Max type scenario. But just as high inflation persists, whatever these futures traders think and say, and whatever the mainstream guys in Wall Street and their models say, if people around the world start saying, you know what, this isn't transitory, I'm a little bit worried, I'm not going to change everything, but I'm just going to allocate a little bit to a safe haven asset like gold and or silver. But you know what, if it goes to the historic average that Rick cites, that's a fourfold increase in investment demand for gold, which is almost all the demand for gold, different for silver. But even if it doesn't go there, let's say it just goes halfway to the historical average, to 1%, that would still double the demand for gold. And that has to have an impact on prices, regardless of what the models that these traders and the Wall Street guys use say should be happening with real rates. So we're in a curious time, Elijah, where that relationship with real rates has actually come unglued over the last year as people have started looking more directly at the dollar. We've talked about that before, how gold has been trading and moving on a day-to-day basis more directly in response to the dollar. We've also seen multiple instances in the last couple months of some kind of news that would normally make the traders sell off gold and silver. And then that happens, but then in the same day, you'll see some other buying come back in again. Like we've seen this irony of news that's related to inflation, high inflation being bad for gold because the traders think the Fed's going to raise rates and that's bad for gold. What we've seen more recently, though, is another kind of buying step in when that happens, where it looks like people are saying, you know what, high inflation, I want some gold. So we might see very different dynamics going forward this year. The real rates thing, I think, will only be part of the story. There's evidence now that there's another kind of buying out there. And if we get Rick Rule's dream, of things reverting to the mean, hold on to your hats.
Now, one kind of wild card out there at the moment is with Ukraine and Russia. How do you think I guess in either scenario, if Russia does invade Ukraine or not, how do you think this will rattle the markets?
I'm glad you put it that way, because I think over the longer perspective, the answers actually do net out to be pretty similar. In the short term, we've already seen a taste, I think more than taste. We've seen very clear evidence. If there is an invasion, if after we get off the phone, we look at our screens and we find out the bombs are falling, clearly the markets will respond. I think it will be a knee-jerk higher for gold and silver. The last time this happened in 2014, gold increased around 16 or 17% in a matter of weeks, when Russia took Crimea. If that were to happen now, that would put gold back over $2,000 an ounce. And I think that would have a pile-on effect. It would attract a lot of other people. So we could see a bigger rise than we saw in 2014. I think that there's plenty of evidence for that right in front of us right now. But at the end of the day, as much as I love my Ukrainian friends, and I really do have quite a few there, I've taught economics and entrepreneurship in Kiev before, and Alushta, Ukraine. So I really do have friends there, and I feel for them. But it's something that we've already seen before. The rest of the world is likely to shrug off at the end of the day. I mean, Russia already took a large chunk of that country and basically suffered no long-term ill consequences. So I think if worse comes to worse, it'll be terrible for our Ukrainian friends, but the rest of the world moves on as far as the conflict itself goes. Now, if the sanctions and the response actually is bigger, if the West decides, if Europe decides we're going to put on 3 coats this winter and not buy any Russian gas, and they stick with that, I'm not sure they can. I'm not sure how feasible that is. But if they did something like that, it would, and they stuck with it, they stayed with that, that would be major. Or the so-called nuclear option. If the U.S. freezes Russia and any allies out of the SWIFT system, they are working on replacements. I understand that they have hardened their own internal transaction systems, but there still really isn't a global alternative to SWIFT as I understand it. So that would cause serious harm. That would roil markets. And, you can say, well, it serves the Russians right. They deserve to be, frozen out for being bad actors on the international stage. Well, fine. But remember, they have trading partners. Even the U.S. buys fuel from Russia. So it has consequences for both sides. And this is why I've said I'm not a military expert. I don't have friends at the CIA who feed me secret information or anything like that. But just as a person who's been in the region and looks at the world and looks at human nature, I see very high costs on both sides. It makes sense to me to see Putin pushing back on NATO. I understand that agenda. But it does not make sense to me to see either side pushing this into a hot war that would have very high costs for everybody. So I don't know, maybe the bombs start falling when we get off the phone, Elijah, But I actually don't think that's going to happen. I do think this blows over. And, either near term. I mean, as you and I speak, there are actually reports of Russia starting to withdraw some troops. So, there are other reports about attack positions. So who knows? But if it is starting to blow over, great. If it doesn't, I think eventually for the world, it probably does. But we'll just have to see. It is a wild card, as you say. And here's the big takeaway, though. We've seen this before. It happened just a few years ago in 2014 when Russia took Crimea. And eventually the world, shrugged it off and went on. So I hate to say it for my friends in Ukraine, but that's my base case expectation here, however this plays out. So wild card, but not long-term, not likely to be a long-term change. Unless this really is the beginning of separation of East and West, and Russia and China band together against the U.S. and its European allies, and the world becomes economically divided in a really serious and permanent way, that would be, I think, very bad, very bearish for many things over the long term, but actually bullish for commodities, because that would be the mother of all supply chain disruptions. But that's not my base case expectation. I think the costs of that are so high, neither side or no side wants that to happen.
If people are looking to learn more, they can go to independentspeculator.com and subscribe. Did you want to share with our viewers a little bit about that?
That's the invitation to stop listening, Q, but sure. As usual, I always encourage people to sign up for our free weekly letter because it is free. You can get a sample and feel for what kind of work I do. And we don't spam our free readers. If you sign up for that, you won't get a flood of daily advertisements in your inbox. You just get the one email. You can, have a feel, like I say, for what my analysis is like and what I can do for you, and we'll see what happens. But thank you for the invite on that, Elijah.
Fantastic. And any last thoughts before we let you go, Lobo?
Yeah, let me see if I can say this succinctly. It's hard for financially oriented people to put too much weight on wishy-washy psychology like I'm talking about with the Great Reopening. But I do see this as a major, truly historic event. And maybe you don't completely change your entire portfolio to try to benefit from the Great Reopening. But I do think people should take that seriously and seriously consider, what can I reasonably do without, crazily going out on the high risk end of the spectrum to benefit from the Great Reopening. I see this as a near-term catalyst for potentially major gains in several areas.
All right. Well, Lobo, it'll be really interesting to continue to track all of this with you. Once again, thank you so much for your time, and God bless.
Thank you, Elijah. You too.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.